Hi folks, so yesterday we posted the answer to the question on October 20th. So we had this quiz where we asked what is the right multiple to use while comparing companies with different capital structures. So this is a more in-depth session where I'm going to go and delve a little bit deeper. So before we go into the multiples analysis and what is the right multiple, I want to just re-jog your memory about valuation. So as you know, there are 4 ways in which we can value a company, right? So when we think of valuation as CFA charter holders, most of us will go into what we call as the cash flow or intrinsic valuation, right? So this is your DCF. You are projecting the cash flows and then discounting it back to the present to get the value of a company, whether it is a publicly traded stock, whether it is a private equity valuation, it's a private company that you're valuing as part of a VC investment. So this is a very standard methodology. But there are some limitations. What if the company doesn't have cash flow? You are a VC, the company is just starting, you don't have cash flow for the company yet. So that's where the second methodology comes in handy, which is the multiples. And this is what we looked at in the question there. So there are many multiples. Price to sales. So this is a sales-based approach. You can use an earnings-based multiple like P over E, PE multiple. Another earnings-based multiple is going to be the EV over EBITDA. So that's quite a mouthful. Enterprise value over EBITDA. So in the answer we had said this is the right multiple to use, and we're going to look at all of these multiples and figure out why EV over EBITDA is the right multiple. It can also be an asset-based multiple, right? Price to book, for example. So there are various multiples based on the metric that we are going to be using. So apart from multiples, you can also use asset-based valuation. So I'm not going to go in depth about all of these, just jogging your memory on the 4 types of valuation techniques. And then we have optionality, where we use option pricing to value the firm. Right? So particularly this is true for companies that have binary outcomes. So let's say you are a pharma company and a lot of the valuation depends on whether this particular drug is going to be approved by the FDA or not. Okay, so now let's jump into the multiple analysis. So as we discussed, there are various metrics we can use to do the multiples. These are 4 metrics, right? Sales, earnings, assets, and cash flow. And you know, in the .com times, they were even using eyeballs. So it could depend on the situation. So let's assume you are looking at a startup. So a startup doesn't have cash flow yet. It's just started selling something. So typically you start with the sales multiple for that kind of a firm that doesn't make profits or a free cash flow yet. So price to sales. So 2021, a lot of deals were getting priced at 10 times, 5 times, 20 times. And now in 2022, it's getting 2 times, 3 times, right? So price to sales is a very easy metric for companies that don't have earnings yet. So once you have earnings, PE multiple is a very common multiple. If you are looking at stocks, it is one of the common ways to compare publicly listed stocks. What is the issue with PE is that it only talks about the earnings after tax. So P stands for the market capitalization of the stock, and E is the earnings after tax, right? PAT, as we call it. So let's assume the PE of a company is 10, and the market capitalization or the valuation of the company can be calculated by the PE ratio times the earnings. Let's say the earnings of the company is $1 billion. It's a relatively big firm. So the valuation of the firm is $10 billion. So what is the issue here? So let's assume this company has taken $1 billion in debt and has leveraged the balance sheet. So the earnings are over-indexed, whereas a company that has no debt is going to have lesser earnings. And all of this impact of debt muddles the ratio. Instead, the EV to EBITDA ratio takes into account the total value, not just the equity market cap. So the EV EBITDA uses the enterprise value, which takes into account not just the equity market cap, but also the net debt, that is the total debt, subtracting the cash that you have. So when you have the total market cap or the enterprise value, you have both the equity component and the debt component. And then you are dividing it with an earnings that is before your interest, that is your debt servicing cost, as well as taxes, depreciation, and amortization. Because your ability as a business to generate profits usually is not related to the tax, because that is based on the tax laws of that particular country. And same thing with depreciation. We are just doing this arbitrary way of amortizing or spreading out the cost of the fixed assets over a period of time. So enterprise value captures all the market capitalization, and EBITDA is a complete earnings. So in a lot of ways, you don't have to worry about the tax rate, the debt that they have taken, etc. So it is agnostic to the capital structure, to the tax rate, your depreciation policy, whether it is a straight line, whether it is accelerated, doesn't matter. That's one of the reasons why PE guys, VC guys really like the metric. As long as you have a positive EBITDA, this is a really good metric to use to evaluate and compare companies across capital structures.